Today, we are going to discuss the oil markets, clearly in focus with everything that's going on in the Middle East. So we'll discuss that issue, some of the other factors driving price action, and of course, have a look at the technicals. Any discussion about oil naturally has to begin with tensions in the Middle East. At least right now, we've seen prices rise amidst concerns that the conflict escalating between Hamas and Israel may spiral into a broader regional conflict that, will amount to another significant supply shock for the global economy. So what are the threads that we're really following? Well, naturally, there's the fears around damage to key energy infrastructure across the region. Already, we've seen Israel turning off a natural gas plant for a couple of reasons. One, to remove it as a target for Hamas militants and perhaps some of its adversaries. Two, probably to try and plan for a redirecting of gas exports back into domestic consumption if it needs to feed effectively what is its war machine. So that has had knock-on effects to the oil price via the gas market. But in particular, the real concern here is that if we do see a ground offensive launched by Israel into the Gaza Strip in retaliation for Hamas's attack a few weeks ago, there is questions about how the Iranians may be implicated in that, in particular because there seems to be evidence, and this is just based on common reportage at the moment, that Israel was very well aware of Hamas's attack before it occurred, raising questions effectively of what will Iran's influence be going forward if we do see an escalation in tensions, and what the international community's response will be, whether it will result in further sanctions. We do know that there's already major financial and trade sanctions on Iran, but they are, perhaps somewhat loosely enforced, and Iran still sells a lot of its oil on the black market, which by extension keeps some level of downward pressure on oil prices. If we see those tightened up just a little bit, then maybe that adds to some of the supply pressures across the globe. So we're going to be continuing to keep an eye on that conflict. Clearly a very sensitive situation, a humanitarian crisis, but one, if it escalates, and again, that could come if we do see a ground offensive from Israel into Palestinian regions, then, and in, I should say, in particular, the Gaza Strip, then that could catalyze that next upside move, at least in the very short term, in oil prices. But let's move across to some of the other factors driving the market now, because, clearly there were upward pressure on prices coming through from some of the other macroeconomic fundamentals. Let's talk about the supply situation at the moment. OPEC clearly very keen to enforce some level of supply deficit in the oil markets to put upward pressure on prices. The reasons for that is multifaceted, and each OPEC member and member of OPEC Plus, if you will, have their own reasons for wanting higher prices. But Saudi Arabia in particular, not just wanting to keep the cohesiveness of the cartel in place, but very much concerned with its own public finances and the need to fund some of the major spending projects that it has embarked upon, which will obviously be supported by a higher oil price. So we're still seeing, although I should say the last OPEC meeting passed without any changes to official policy and output going forward, we still see forecasts from OPEC coming through that there will be a roughly 3 million barrel per day deficit in the global oil market in Q4. That will be the biggest deficit since 2007 if it materializes. So clearly a statement of intent there from OPEC that it wants oil prices probably above 90 when we look at Brent. There's also the concerns around effectively US supply at the moment, and that's both a demand and supply story. On the supply side of things, we are seeing a fairly significant drawdown in US crude inventories. There is talk, or there has been talk over the last few weeks, perhaps months, from members of the Biden administration that if things get a little sticky there, to say the least, especially if the global macro backdrop gets somewhat disrupted, if you will, that the US could dip again into its strategic petroleum reserves. However, those reserves are at close to 40-year lows, in fact, perhaps even greater than 40-year lows. And one must recall that the Strategic Petroleum Reserve doesn't exist as a counter-cyclical measure to try and lean against oil prices. In principle, it's there for emergency settings like major conflicts, or perhaps things like natural disasters, things that could cut supply of energy into the United States, and that reserve is there to try and help through some of those emergency situations. Again, I can't express enough, not as a sort of counter-cyclical measure as we've seen it being used in recent times. So there might be less of an impetus there for the United States to try and massage prices lower using the its strategic reserves. And the recent US crude inventory data shows a building deficit in the market. In fact, the drawdowns that have come are far exceeding those that are projected by economists. And we're getting to levels now that is flashing amber signals about US supply. At a time, it has to be said too, and this is the other factor in US energy markets at the moment, when economic activity is relatively robust in the United States. Now, of course, globally, we're dealing with a very patchy economy right now. China's growth, while picking up a little bit, we've seen that in some of the data this week, is still a little bit mixed, especially when it comes to the supply side of its economy, so its manufacturing sector. But Europe's weakening as well. And we are seeing this, again, very kind of patchwork economy across the globe. Nevertheless, the US economy is resilient. It is leading to higher energy prices, higher inflation expectations too, which is a part of the story when it comes to higher US Treasury yields. And that mix of resilient growth as well as supplies becoming reasonably dwindled output, not keeping up particularly well, is putting upward pressure on prices. So that's some of the factors that are driving things fundamentally right now. Again, there's this supply shock, which one should mention, if you look at implied volatility in the market, we're not looking at, well, as far as perceptions right now, a shock that would be to the same scale as Russia's invasion of Ukraine. But nevertheless, there is still a very significant and meaningful lift. It has been a significant and meaningful lift in implied volatility in Brent futures markets to suggest that, well, we are dealing with a highly uncertain environment prone to potential shocks here at a time when supplies are significantly dwindled for a number of factors. So let's take a look at the charts now and get a sense of what the technicals are telling us. Now, this is Capital.com's price on the West Texas Intermediate contract. But what I see here at the moment is a market plagued by uncertainty, of course, and indecision. Really, price action is starting to wind up like a tightened coil. And you can see that in the RSI, which is fairly neutral overall in terms of momentum, but has seen some fairly violent shifts to the upside and downside, especially as we've, come through or dealing with this evolving situation in the Middle East. Now, one might note here that as it stands currently, we're coming at something of an ascending wedge pattern in price, which is typically a signal of a potential reversal in the prevailing move. And considering structurally at the moment, you can say that, and perhaps for the bulls here, that we are in something of an uptrend for oil prices at the moment. This kind of ascending wedge pattern seems to point to potentially a greater pullback here in the oil price. However, when we are talking about the uncertain macro backdrop here, if anything does happen to transpire that raises concerns about supply here, well, we are looking at risk skew to the upside and a price of oil that is coming to a fairly key level. As you can see there, we'll call it around $87.5 bucks per barrel to $88 per barrel. And if we do push above that level and see a bit of a move higher when it comes to momentum, that's the sort of impetus that could see this uptrend continue for oil prices. And we'll zoom out just a little bit into the weekly chart here as well to get a sense of the key levels in the bigger picture. But a breakout to the upside through that kind of 87.5, 88 level does bring back into focus that $90 handle or thereabouts. And one notable message to get across here is that although we have seen the price of West Texas Intermediate climb above $90 at different stages over the last couple of months or so, it has been the move has invited sellers into the market and it's been very, very rarely consolidated above that level. So what that says to me is that if we do see a breakout to the upside because of potentially some sort of shock related to what's going on in the Middle East, we will get a good sense of where the prevailing move will be next, whether the trend will continue. If we see a weekly close above that $90 level, and even better, a consolidation above that level too. Now, of course, there is a possibility that the situation in the Middle East, as well as just this global growth narrative too, starts to turn to the downside, notwithstanding some of these supply pressures. And we'll go back to the daily chart here very briefly. And if we do see this ascending wedge pattern break down, as again, one would assume it is indicating just by virtue of that technical setup, then we start to beg the question as to whether we sort of pull back towards this key, this key support resistance zone just above $80 per barrel, the very kind of deep sell-off that you might see in any kind of narrative changing move in the market. Well, that's down below sort of $78 where the 200-day moving average is, and also a key level of previous resistance that did turn into support. So again, there is no clear signals, I think, in the price action at the moment of where the market could go next. We're getting some fairly mixed signals from the price action. But of course, we'll just have to be keeping an eye on the macro, both from in terms of the geopolitical factors in the Middle East, as well as some of these kind of supply-demand imbalances to get a read on, where the price could move next and whether we will see a fairly significant, meaningful breakout to the upside or downside. So there we go. That's the lay of the land at the moment in what is a very fast-moving energy market, a very fast-moving oil market. Again, just keep an eye out for what's going on in the Middle East and the potential implications to global energy supply, along with the supply and demand dynamic that could tell us fundamentally where the markets could go next, and whether some of those key signals that we're seeing on the charts start to play out one way or another.